Today for the Series 6 exam, we're diving into the critical decision an investor makes when they annuitize their variable annuity, choosing a payout option. This is when a lump sum of accumulated money is converted into a stream of income payments. The exam will test your understanding of how each choice impacts the annuitant's monthly income and what happens to the money when they die. Let's start with the option that generates the highest possible monthly payout. The life annuity, also known as straight life. This option promises to pay the annuitant a periodic income for their entire life, no matter how long they live. The trade-off for this high payout is significant risk. The moment the annuitant dies, the payments stop completely. There is no death benefit, and no money passes to a beneficiary. An exam question might describe a client who is single, has no dependents, and whose primary goal is to maximize their income during retirement. In this scenario, the straight life annuity is the most suitable recommendation. The common trap is suggesting this option for a client who has a spouse or other dependent who relies on their income, as that person would be left with nothing. Next, we have the life with period certain option. This selection also pays an income for the annuitant's life, but it adds a layer of protection. It guarantees that payments will be made for a minimum number of years, such as 10 or 20, even if the annuitant dies sooner. If the annuitant dies during that certain period, their named beneficiary will receive the remaining payments until the period ends. For example, a test question can feature a client who chooses a life with a 15-year period certain. If she passes away in year 5, her beneficiary will continue to receive payments for the next 10 years. Because of this guarantee, the insurance company lowers the monthly payout compared to a straight life option. The longer the guaranteed period, the lower the monthly payment will be. Finally, there is the joint and last survivor option. This is designed for two people, most often a married couple. It provides income payments that continue as long as either of the two annuitants is alive. This option provides the greatest degree of security for a couple, ensuring the surviving spouse will not lose their income stream. For this reason, it typically provides the lowest initial monthly payout of all the options, as the insurance company is basing the payments on 2 life expectancies, which creates a longer potential payout period. A common exam scenario will involve a couple wanting to ensure the survivor is financially secure. Be aware of a nuance the test might include. The payout to the surviving annuitant might be the same, or it could be reduced to a percentage, like 75 or 50% of the original payment. To keep these straight, let's use a simple phrase. More people and more promises means less pay. A straight life annuity covers just one person with no promises to a beneficiary, so it has the highest pay. A life with period certain adds a promise to a beneficiary for a set time, so it has less pay. A joint and last survivor annuity covers 2 people, representing the biggest promise from the insurance company, so it has the lowest pay. Remembering this simple trade-off between guarantees and income levels will help you navigate these questions on the exam.